On Monday, we had the governor cut the monetary policy rate by 100 basis points from 17% to 16%. We've seen that over the course of 1 year, that's from January 2017 till date, we've seen the rate drop from about 25.50% to the current 16%. We've also seen inflation trend downwards into the single-digit ranges. And Bank of Ghana says they have a target of 8 plus or minus 2%. That's between 6 and 10%. One would argue that all is well and good. Is that so?
Well, broadly, yes. All is well and good, especially if you consider where we came from. And I would like to roll back the hand of time and remind ourselves of the fact that the last time we saw single-digit inflation was early 2013. And that sustained from the single-digit inflation we recorded from somewhere late 2010, and it remained in the single-digit until early 2013 when, because of the exit from then IMF program and the election excesses from 2012, things went back up. And then we had remained in double digits until then. And then we embarked on both fiscal consolidation and monetary tightening to ensure that inflation comes back within the band of 6% to 10%. So it appears the trend we have seen in the last couple of years has pointed to a positive direction. So on that count, I can say all well and good, but with a lot of caution to the outlook.
Okay, you mentioned the International Monetary Fund, the IMF, and us in 2010 coming out of an IMF program as part of the reasons for the single digit at that time, if I'm right. Given the current dispensation, do you think what we are seeing right now is as a result of the Monetary Policy Committee's actions or moves, or there's some influence coming from our IMF ECF supported program?
It's a combination of all these factors. And again, let me remind us of something that's happened when the program started. In 2015, when this current IMF program started, we noticed that inflation was in double digits and running upwards at the time. Then also you look at the policy environment and you could see the lack of credibility, particularly with monetary policy. There was a lack of credibility, and essentially that's why we went for the IMF program. How do you notice this lack of credibility? In 2015, when the IMF program started, we had market interest rates, such as the short-term rates like the 91-day interbank interest rate and so on. They were around 24%. But at the time, we had the monetary policy rate, which is supposed to be the punitive rate, being below the 24% mark. It was at 21%. At that point, the signal is that you can get liquidity cheaper from the central bank than from the market. It should have been the other way around. So given that scenario, monetary policy had lost credibility at that point in time. But since the program started and the analysis of the market, they had to start adjusting the policy rate to make it more credible. And then we saw the policy rate going back up to 26% and was maintained at 26% for 12 solid months, 1 year. So that over that period, it had tightened the economy or money supply to the point where aggregate demand was restricted and the demand side pressures were contained. And then that started slowing down the rate of increase in general prices. And so we saw inflation coming down. In addition to that, we saw a complementary fiscal policy. In other words, government budget operations complemented the efforts of the central bank to bring down inflation. You recall that in 2017, for instance, there were a lot of taxes that were knocked off. You also recall that we saw a reduction in the special petroleum tax. All these policy measures from the fiscal side of things helped to reduce the cost side to inflation and helped non-food inflation down. And broadly speaking, the headline inflation trend tends to mimic the non-food inflation trend. So as non-food inflation started coming down, we saw a corresponding decline in the headline inflation. So I would say it's a combination of everything. Credible monetary policy helped by the start of the IMF program and as well as complementary fiscal policy.
Kwesi, Carrie has just given us some perspective. We've had a good balance between monetary policy and fiscal policy. The Monetary Policy Committee meets on a bi-monthly basis, so that's 6 times a year. The next meeting is in March. In your estimation, what do you think are the risks? Because right now, Carrie argues that all is well and good. What do you think are the risks we should look out for? What do you think can throw out this inflation single digit out of gear back to the double digits we just spoke about? What do you think can throw us out of gear?
Well, the Bank of Ghana primary objective, we all know, is to ensure price stability. And that is all they try to do with their policy tools, all the policy tools available to them. The MPR is just one of those. And then so they analyze really what is happening to the outlook for inflation, expectation, underlying inflation, and all of that in coming out with a decision. Now, for this particular decision, I think all the arguments they adduce to why they reduce the rates are factual and valid. Yes, inflation has been on that downturn since 2016, all the way to where we are now. Underlying inflationary pressures, which is actually the correct measure or the appropriate measure of inflationary pressures, and that may determine the path of monetary policy, is also trending down sustainably. Of course, it's still, that one is in the double digits, yes. I think it printed 10.4 the other time, but then it's on a sustained path of decline. So on that score, you can say they are justified in reducing the monetary policy rate as a means of stimulating growth by easing credits somehow. But the reason we thought, or I'm thinking that the decision probably is rushed or probably should have been delayed for March or even made this policy meeting, is that at this time we are seeing pressures on the market, pressures that could reasonably threaten inflation. Things like currency depreciation. Mm-hmm. I think year to date, the CD has fallen, about some 2.5 or so % versus the dollar. Over the last decade, I think that is the worst start to the year for the currency. And of course, in the last 2 days, we've seen it stabilize around that around 8 to 9 level, right? But then we know that 2.5% depreciation in just less than a month is an anomaly that we don't know what it's going to look like, especially at a time where Bank of Ghana has a lot of reserves, but over the 4 weeks in this year, we haven't seen enough injection of those effects in the system, particularly at a time where the external market is not looking external financing conditions is not looking favorable for EM and then, of course, Ghana. And then so the offshore bond investors who normally will look at our longer dated bonds as a source of injecting liquidity into the system are no more interested in duration. They are looking more at the short-term end of the market. So FS supplies are kind of tight. And the banking system itself is also not releasing as much credit into the system. So those are threats, and inflation is elevated. At the present level, if you want to annualize it, you're talking about some 38 plus depreciation end of year. Now, if that turns out to be the case, then the pass-through from currency depreciation to inflation will actually shock inflation to the upside, which is a risk I think they have taken too lightly. Another thing, the fiscal outlook. Yes, we know we have behaved well in the last 2-3 years under IMF supervision, but we know the IMF will soon lift down. Yeah. The program is ended. We're waiting for the final review somewhere in April. In 2018, the fiscal target said, I think the fiscal deficit at 3.7% of GDP. We ended the year at around 3.8% of GDP. And of course, let's be fair, we will know the size of the GDP in April. Then we can know the actual fiscal deficit. But then tentatively, what we are told is 3.8%. That is how we ended the year. We've exceeded the fiscal deficit target. And then that is under IMF when we are waiting for a final review to be passed or, get the final assessment. Now we are outside IMF in 2019. We are executing an expansionary fiscal budget that would generate all the expenditure pressures we could see in the economy to stimulate again demand to a certain level. And if productivity doesn't grow commensurate with that stimulation in aggregate demand, there could be pressures, liquidity pressures in the system that could trigger inflation. And then that is what I think, or those two principally, is what I think the Bank of Ghana should have been a bit more cautious about in deciding the rate or to cut the rate at this very meeting.